Picture this. You're at an airport somewhere in Europe, let's say Frankfurt, and you've just landed from a long-haul flight. You're tired, you're hungry, and your carry-on smells faintly of the stranger who sat next to you for 11 hours. You shuffle over to a currency exchange kiosk because you're headed onward to a country where they don't take euros. You hand over some cash, the board attendant behind the glass taps a few buttons, and then they slide back a wad of bills that looks suspicious. It's too much. Way too much. You're holding what appears to be a small fortune. Thick stacks of colorful notes with impressive-looking zeros, and for one glorious, delusional second, you feel rich. Then you go to buy a bottle of water and a sad little airport sandwich, and you hand over one of those impressive notes, and you get almost nothing back. The fortune evaporates. The dream dies. You are not rich. You are just holding a currency that happens to have a lot of zeros on it. And that right there is the central mystery we're going to unpack today. Why does money from one country buy so much more or so much less than money from another country? Why is a single US dollar worth more than 1,000 of some currencies, while in other places it barely gets you a coffee? Why do exchange rates exist at all? And why do they constantly change, sometimes wildly, sometimes overnight, sometimes for reasons that seem to have nothing to do with anything logical? We're going to answer all of that. We're going to go deep, and we're going to do it without making your brain melt. Here's what makes this topic genuinely fascinating. Money, when you really think about it, shouldn't work the way it does. A piece of paper, or increasingly a number on a screen, has no intrinsic value. You can't eat it, you can't build a house with it. A $100 bill and a used napkin are, physically speaking, roughly equivalent, and yet one of them can buy you a plane ticket and the other one can get you thrown out of a restaurant. The difference is entirely a matter of collective agreement, of trust, of perception, of institutional architecture, and of a staggering number of economic forces that interact in ways nobody fully predicted. The story of why currencies have different values is really a story about power. It's about which countries the world trusts and which ones it doesn't. It's about inflation, productivity, debt, political stability, oil, gold, and the collective anxiety of financial markets. It's about why some small nations have currencies that are stronger than those of massive economies, and why some big countries have currencies so weak that people use wheelbarrows to carry enough cash to buy groceries, and not in a metaphorical way. Literally. That has happened, multiple times, in living memory. But here's the twist that most people miss. The value of a currency isn't just about how good or bad a country's economy is. It's not a report card. It's not a ranking. It's something far more complex and far more interesting. A strong currency isn't always a blessing. A weak currency isn't always a disaster. And the right exchange rate, the one that actually makes a country better off, is one of the most fiercely debated questions in all of economics. So yes, we're going to talk about all of this. We're going to walk through the history of how humans went from trading cattle and grain to trading abstract numerical representations of value that exist mostly on computer servers. We're going to explain the specific mechanisms that make one currency worth more than another. Things like purchasing power, interest rates, inflation, trade balances, and something magnificently named the impossible trinity. We're going to look at the extreme cases, the currencies that have collapsed spectacularly, the currencies that have held steady for decades against all odds, and the currencies that are so strong they make other currencies feel inadequate about themselves. We'll also get into the surprisingly political world of currency manipulation, because yes, governments do deliberately mess with the value of their own money, and yes, this causes enormous international drama. And we'll explain why the US dollar gets to be the world's reserve currency, which is a title that sounds ceremonial, but is actually one of the most powerful economic advantages any country has ever enjoyed in human history. By the end of this, you will understand something that most people, including a lot of people who really should know better, don't actually understand. Money is not a neutral, objective thing. It is a human invention, constantly negotiated, constantly contested, and deeply shaped by history, politics, and the messy reality of human behavior. And no, before you ask, understanding all of this will not make you rich, but it will make you significantly more interesting at parties, or at least at the right kind of parties. Let's start at the beginning. Not the very beginning. We're not going back to barter systems and clay tablets because we'd be here for a week. but close enough to give us the foundation we need. The core question is deceptively simple. What gives money its value? The answer used to be gold or silver or some other shiny metal that people had collectively decided to value. For most of recorded history, currencies were either made of precious metals or were directly convertible to them. You could walk into a bank with your paper money and demand gold in return, and they had to give it to you. This was called the gold standard, and it had a certain elegant simplicity to it. The amount of money in the world was tied to the amount of gold that existed. You couldn't just print more money if you didn't have more gold to back it up. This kept inflation low and currency values relatively stable, but it also made economies rigid and prone to brutal downturns whenever gold supplies didn't match economic growth. The gold standard started coming apart after World War I, limped through the Great Depression in various patched-together forms, got resurrected in a new version after World War II under something called the Bretton Woods system, which we'll discuss in detail later, and then finally, definitively died in 1971 when U.S. President Richard Nixon, under enormous economic pressure, simply announced that the dollar would no longer be convertible to gold. Just like that. One speech. 44 years of post-war monetary architecture, gone. After that, all major world currencies became what economists call fiat currency. The word fiat comes from Latin, meaning let it be done, essentially a decree. Fiat money has value because the government says it has value and because everyone agrees to go along with it. There is nothing backing it up except confidence, trust, the collective belief that if you hand someone a $20 bill, they will accept it as payment for $20 worth of goods or services. This sounds fragile, and in a way, it is. When that trust collapses, so does the currency. We'll see several examples of exactly that happening, but under normal conditions, fiat currency works extraordinarily well, and it gives governments a tool they didn't have under the gold standard, the ability to control the money supply, to print more money when the economy needs a boost, or to tighten the supply when inflation gets out of hand. This flexibility comes with risks, obviously, but it's also what allows modern economies to respond to crises in ways that would have been impossible 100 years ago. So, fiat currency, money that works because we all agree it works. Got it. Now here's where it gets interesting. If all major currencies are fiat currencies, if they're all just backed by trust and government decree, why are some of them worth so much more than others? Why does one US dollar exchange for roughly 83 Indian rupees, or about 150 Japanese yen, or about 0.92 euros? Why aren't they all worth the same? The short answer is, because the things that create and sustain trust in a currency vary enormously from country to country. Think about what you're really evaluating when you assess a currency. You're evaluating the entire economy behind it. You're asking, is this country productive? Does it make things people want to buy? Does it have stable, predictable governance? Does it have a central bank that manages inflation competently? Is it likely to be around and functioning in more or less the same form in 5, 10, 20 years? Does it have rule of law? Does it have institutions that protect property rights and enforce contracts? All of these things feed into how much people trust a currency, and therefore how much they're willing to pay for it. A country with a booming, diversified economy, low inflation, stable politics, and strong institutions will generally have a currency that people want to hold. Demand goes up, value goes up. Simple supply and demand. A country with a struggling economy, high inflation, political chaos, and weak institutions will have a currency people want to get rid of as fast as possible. Demand goes down, supply goes up, because everyone's trying to offload it, and value collapses. Of course, reality is more complicated than this, much more complicated. Exchange rates are influenced by dozens of factors: interest rates, trade flows, capital flows, speculation, geopolitical events, central bank interventions, and sometimes just the general mood of global financial markets, which can be, to put it diplomatically, mercurial, but the underlying logic is always about trust and value. The currencies that hold their value and that command high exchange rates are the ones that represent economies the world believes in. This is why the concept of currency value is so much more than just a number on a screen. When you look at an exchange rate, you're looking at a distilled verdict, constantly updated, constantly revised, of how the world assesses one economy relative to another. It's like a stock price, but for a country. And just like stock prices, exchange rates can be wrong. They can be manipulated, they can overshoot or undershoot reality, they can be driven by panic or euphoria rather than fundamentals, and they can change in ways that seem completely divorced from anything happening in the actual economy, which is maddening, but also fascinating, and we're going to dig into all of it. But first, let's establish one more foundational concept, because without it, a lot of what follows won't make sense. It's called purchasing power parity, and it's basically the economic equivalent of a reality check. Purchasing power parity, economists call it PPP, because economists love abbreviations almost as much as they love arguing with each other, is the idea that exchange rates should, in theory, equalize the prices of identical goods across countries. If a burger costs $5 in New York and the nominal exchange rate says $1 equals 80 rupees, then that same burger should cost 400 rupees in Mumbai. If it costs significantly less than that, the rupee is undervalued. If it costs more, the rupee is overvalued. The most famous and playful version of this concept is The Economist magazine's Big Mac Index, which has been running since 1986. The idea is simple. A Big Mac is more or less the same product everywhere in the world. So if you compare the price of a Big Mac in different countries, converted to a common currency, you get a rough sense of whether currencies are over or undervalued relative to their purchasing power. The results are consistently fascinating. A Big Mac in Switzerland will cost you roughly twice what it costs in the United States, suggesting the Swiss franc is significantly overvalued, or that Swiss wages are very high and everything in Switzerland is expensive, which, ask anyone who's been to Zurich, it very much is. Meanwhile, a Big Mac in Egypt or Pakistan costs a fraction of what it does in the US, suggesting those currencies are undervalued in PPP terms, or that local wages and costs are much lower. This is the key insight of PPP. Nominal exchange rates and real purchasing power are not the same thing. One US dollar might officially exchange for 80 rupees, but 80 rupees in India can buy considerably more than $1 buys in the United States. The cost of living is much lower, labor is cheaper, local goods and services, and a meal at a restaurant, a haircut, a taxi ride, cost a fraction of what they cost in developed economies. So when people say that India is a poor country because its GDP is much lower than America's in dollar terms, that's only half the story. When you adjust for purchasing power, when you ask how much stuff people can actually buy with their income, the gap shrinks considerably. Not disappears, but shrinks. India's PPP adjusted GDP is the third largest in the world, behind only the US and China. In nominal dollar terms, it ranks fifth. The difference reflects the fact that a dollar equivalent amount of money goes much further in India than in the United States. This matters enormously for how we understand global economic comparisons, living standards, and, crucially, currency values. It also explains why simply looking at an exchange rate and concluding that one country is richer than another is a mistake. The value of a currency is not the same as the wealth of its citizens. These are related, but they're not identical. Alright, we've established the basics. Money is a collective fiction backed by trust. Fiat currencies derive their value from confidence in the underlying economy. Exchange rates are dynamic verdicts on relative economic health. And purchasing power parity reminds us that nominal exchange rates don't tell the whole story. Now we're ready to get into the specific mechanisms, the actual gears and levers, that determine why one currency is worth more or less than another. And we're going to start with the most powerful single factor, inflation. Inflation is, in many ways, the silent enemy of currency value. When prices rise within a country, each unit of that country's currency buys less. A dollar that could buy a loaf of bread last year can only buy 3/4 of a loaf this year if inflation has been high enough. The bread didn't get more valuable, the dollar got less valuable. Now extend that logic internationally. If a country is experiencing high inflation, prices rising much faster than in other countries, then its currency is losing purchasing power faster than other currencies. And since exchange rates are partly about relative purchasing power, the high inflation currency tends to weaken against the lower inflation ones. If you're holding the currency of a country where inflation is running at 50% a year, you are watching your wealth evaporate in real time. Naturally, you want to exchange it for something more stable. That selling pressure drives the currency's value down further. This is why inflation control is one of the primary mandates of central banks around the world. It's why the US Federal Reserve, the European Central Bank, the Bank of England, and most other major central banks treat price stability as essentially sacred. When they fail at it, when inflation gets away from them, the damage to the currency can be swift and severe. We'll see some extraordinary examples of this when we get into hyperinflation. But for now, the key point is, high inflation equals weakening currency, all else being equal. The flip side of this is interest rates, and here's where things get genuinely interesting. Central banks fight inflation primarily by raising interest rates. When interest rates are high in a country, holding that country's currency becomes more attractive. You can earn more interest on deposits, more return on government bonds. This draws in foreign investors, capital flows into the country to take advantage of higher returns, and that increased demand for the currency drives its value up. This is why, when the US Federal Reserve raises interest rates, the dollar tends to strengthen against other currencies. Money flows into dollar-denominated assets. Investors from around the world buy US bonds because the yields are attractive. To buy those bonds, they need dollars, so they exchange their euros, yen, pounds, and whatever else they have, and that demand strengthens the dollar. Conversely, when interest rates are very low, as they were in much of the developed world for a decade after the 2008 financial crisis, investors go looking for better returns elsewhere. Capital flows out toward emerging markets, or wherever yields are higher. This tends to weaken the low interest rate currency and strengthen whatever currency the capital is flowing into. The relationship between interest rates and currency values is one of the most important in all of international economics, and it's also one of the most treacherous for policymakers. Because here's the dilemma. If you raise interest rates to strengthen your currency and fight inflation, you also make borrowing more expensive, which slows economic growth and can tip you into recession. If you lower interest rates to stimulate growth, you might weaken your currency and import inflation. There's no free lunch. Every monetary policy decision involves trade-offs, and those trade-offs play out in exchange rates in real time. Speaking of trade-offs and exchange rates, let's talk about trade, because the flow of goods and services between countries is another massive driver of currency values. When country A exports a lot of goods to country B, those goods are typically priced and paid for in country A's currency. Country B's businesses and consumers need to acquire country A's currency to make those purchases. That demand for country A's currency, driven by trade, tends to strengthen it. Meanwhile, country B is selling off its own currency to get country A's, which puts downward pressure on its own exchange rate. This is why countries with large trade surpluses, meaning they export much more than they import, tend to have strong currencies. China, Germany, Japan, South Korea, these are all countries with historically large trade surpluses and all have currencies that are in high demand because the rest of the world needs them to buy their goods. Countries with large trade deficits, importing much more than they export, face the opposite pressure. They're constantly selling their own currency and buying foreign currencies to pay for imports. That continuous selling pressure tends to weaken the currency over time. Now here's a fascinating exception to that rule, and it's one of the most important and counterintuitive facts in all of international economics. The United States runs the largest trade deficit in the world, by a significant margin, and yet the US dollar is the strongest and most important currency in the world. How is that possible? The answer lies in something we mentioned earlier and we'll explore in depth. The dollar's status as the global reserve currency. It's a bit of a cheat code, honestly, and understanding how it works and how America got it requires us to go back in time to a pivotal moment near the end of World War II, but that's going to take us into our next chapter, so we'll get there. First, let's close out the intro by stepping back and appreciating the full scope of what we're going to cover. We've set up the question, why aren't all currencies worth the same? We've established that money is a collective trust mechanism, that fiat currencies derive their value from confidence and economic fundamentals, and that exchange rates are shaped by inflation, interest rates, trade balances, purchasing power, and much more. What we haven't gotten into yet, and what's going to make this genuinely jaw-dropping, is the extreme cases. The currencies that have lost 99% of their value in a single year. The countries where people have carried cash in wheelbarrows not because they were rich, but because denominations had become so inflated that a single loaf of bread cost billions. the countries where governments printed money so fast that the printing presses literally couldn't keep up, and they had to start using whatever paper was available, including, in one famous case, printing money on the back of existing banknotes. We'll also get into the currencies that have done the opposite, that have held their value with such stubborn tenacity that they've become legends in financial circles. And we'll look at the modern currency landscape, the dollar's dominance, the rise of the euro, the ambitions of the Chinese yuan, and the wild card of cryptocurrencies, which represent either a genuine revolution in how we think about money or the most elaborate collective delusion in financial history, depending on whom you ask. There's also the deeply strange world of currency pegs, where small countries tie their currency to a larger one, essentially outsourcing their monetary policy, and the dramatic moments when those pegs break, causing economic earthquakes that ripple around the world. And we'll examine currency wars, the ongoing low-grade conflict between major economies over exchange rates, which are far more common and far more consequential than most people realize. So, inflation, interest rates, trade, purchasing power, reserve currencies, gold, Bretton Woods, hyperinflation, currency crises, pegs, manipulation, and the future of money. All of it in the next several chapters. If that sounds like a lot, it is. But by the time we're done, you will have a mental framework for understanding how the global monetary system works that most people never develop, even after years of reading financial news. You'll understand why things happen the way they do, not just that they happen. Ready? Let's go. Chapter 1, The Architecture of Value, What Actually Makes a Currency Worth Something. Let's start with a thought experiment. Imagine you've just woken up in a parallel universe. Everything is exactly like our world except for one thing. Overnight, every government on Earth has simultaneously announced that their currency is now worth exactly the same as every other currency. $1 equals 1 euro equals 1 yen equals 1 rupee equals 1 bolivar equals 1 everything. The Great Currency Equalization, they're calling it. Politicians are giving speeches. There are fireworks in some places. Now ask yourself, how long does this last? The answer, if you know anything about how markets work, is approximately 45 minutes, maybe less, because within moments of that announcement, traders, investors, businesses, and ordinary people around the world would start making decisions based on the actual underlying differences between these economies. They would move money out of currencies backed by weaker economies and into currencies backed by stronger ones. They would exploit the absurdity of pretending that the currency of a country with 20% annual inflation is worth the same as the currency of a country with 2% inflation. The market would immediately, violently if necessary, correct the fiction. Exchange rates would diverge, the equalization would collapse, and we'd be back, more or less, to where we started. This thought experiment reveals something important. Currency values aren't arbitrary. They aren't random. They reflect real differences between economies, real differences in productivity, stability, and trustworthiness. You can try to override those differences by decree, but the underlying reality reasserts itself, usually fast and painfully. So what are those underlying realities? What are the actual building blocks of currency value? Let's go through them systematically, not in a boring textbook way, but in a way that helps you actually understand why they matter. Section 1. Productivity and economic output. The most fundamental driver of a currency's value is the underlying productivity of the economy it represents. Think about what a country's currency really is. It's a claim on the goods and services that country produces. When you hold dollars, you have a claim on American-produced goods and services, American technology, American food, American real estate, American labor. When you hold euros, you have a claim on European output. When you hold yen, you have a claim on Japanese output. So, the more productive an economy is, the more valuable stuff it makes, the more desirable its exports, the more sophisticated its industrial base, the more people around the world want to hold its currency. Because holding that currency gives you access to those goods and services. This is why the currencies of advanced industrial economies generally trade at higher values than the currencies of commodity-dependent or low-productivity economies. Germany exports precision machinery, luxury cars, and sophisticated chemicals that buyers around the world desperately want. To buy those things, you need euros. That demand for euros driven fundamentally by demand for German products, is a constant upward pressure on the currency's value. Compare that to a country that primarily exports raw commodities, copper ore, agricultural products, timber, at prices set by global markets that fluctuate constantly and over which the country has little control. The demand for that country's currency is tied to commodity prices, which means it can be volatile and, over the long run, less sustained. When commodity prices fall, the currency falls. When they recover, the currency recovers. It's a roller coaster rather than a foundation. This is also why economic diversification matters so much for currency stability. Countries that produce a wide range of goods and services are less vulnerable to the collapse of any single sector. Their currencies can absorb shocks better. Countries that depend heavily on one or two export products, oil exporting nations are the classic example, can see their currencies swing dramatically with global commodity prices. Nigeria's naira, for example, is closely tied to the global oil price. When oil is expensive, petrodollars flow into Nigeria, demand for the naira rises, and the currency strengthens. When oil prices crash, as they did spectacularly in 2014 to 2016 and again in 2020, the flow of dollars dries up, demand for naira evaporates, and the currency can weaken sharply. Nigeria is an enormous country with more than 200 million people, tremendous natural resources, and a large economy by African standards. And yet its currency is fragile in ways that a more diversified economy's currency would not be, purely because of this commodity dependence. The inverse lesson is instructive. Switzerland, a tiny landlocked country with no natural resources to speak of, has one of the strongest and most stable currencies in the world. The Swiss franc is considered a safe haven, one of those currencies that investors run toward in times of global uncertainty, not away from. Why? Because Switzerland has built an incredibly sophisticated, diversified, high-value economy. It's a global center for financial services, pharmaceuticals, precision manufacturing, and technology. Its institutions are impeccably stable, its inflation record is pristine, and because it has a long tradition of political neutrality, it's never associated with geopolitical conflict in the way that other major economies sometimes are. The franc represents a claim on an economy that the world trusts deeply, and that trust is reflected in the currency's extraordinary durability. The lesson: currency strength tracks economic sophistication over the long run. Not perfectly, not immediately, and with many exceptions. But the relationship is real and powerful. Section 2. Inflation, the slow-motion currency destroyer. We touched on inflation in the intro, but it deserves much deeper treatment because it is, without exaggeration, the single most important variable in determining a currency's long-term value trajectory. Here's the core concept, stripped down to its essence. Inflation is the rate at which the general price level rises within an economy. When prices rise, each unit of currency buys less. A 10% annual inflation rate means that after 1 year, your money can only buy 90% of what it could before. After 10 years of 10% inflation, your purchasing power has fallen to roughly 35% of where it started. Your money is worth just over a third of what it was. Now think about that internationally. If country A has 2% annual inflation and country B has 10% annual inflation, then over time country B's currency is losing purchasing power much faster relative to country A's. If they start with an equal exchange rate, rational actors will over time demand more of country B's currency to get the same amount of country A's, because country B's currency is worth less and less in real terms. The exchange rate will shift to reflect the differential in inflation rates. This is actually formalized in economics as something called purchasing power parity theory, which we introduced before, and its close relative, the relative version of PPP. The relative PPP theory predicts that exchange rate changes between two currencies should roughly equal the difference in their inflation rates over time. High inflation. Countries should see their currencies depreciate. Low inflation countries should see their currencies hold value or appreciate. Real-world data, over long periods, supports this reasonably well. Turkey has had persistently higher inflation than the Eurozone for decades, and the Turkish lira has lost enormous value against the euro over that time. Argentina has had chronically high inflation, sometimes extreme hyperinflationary episodes, and the Argentine peso has depreciated from 1 peso per dollar in 2001 to, at various recent points, more than 800 pesos per dollar and counting. The erosion of purchasing power shows up, eventually and inevitably, in the exchange rate. But here's the subtlety. The relationship between inflation and exchange rates isn't always neat and immediate. Financial markets are forward-looking. They don't just respond to current inflation, they respond to expected future inflation. If investors believe that a country's central bank is credible, that it has the tools, the will, and the institutional independence to keep inflation under control, then even a temporary spike in inflation won't necessarily send the currency into a tailspin. The market trusts that the central bank will fix it. Central bank credibility is, itself, an enormous driver of currency value. A central bank with a long track record of successfully managing inflation, the German Bundesbank before the euro, the Swiss National Bank, the US Federal Reserve to a large extent, creates a kind of institutional capital that acts as a stabilizer for the currency. Markets trust these institutions. They give them the benefit of the doubt. They don't panic at the first sign of trouble. By contrast, a central bank with a history of capitulating to political pressure, of printing money to finance government deficits, of abandoning inflation targets when they become inconvenient, is constantly fighting a credibility deficit. Every uptick in inflation triggers fears of a repeat of past disasters. Markets are quicker to sell the currency, quicker to demand a risk premium, quicker to run for the exits. This is why institutional independence matters so deeply for currency value. Countries where the central bank is genuinely independent of political control, where the president can't call up the governor and demand interest rate cuts in exchange for keeping their job, tend to have more credible monetary policy and, over time, more stable currencies. The opposite of central bank credibility is a phenomenon economists sometimes describe as fiscal dominance, where the government's need to finance its spending effectively overrides the central bank's ability to maintain price stability. When governments run large deficits and can't or won't finance them through taxation or normal borrowing, they sometimes pressure the central bank to simply create money. The newly created money finances government spending in the short run, but it also increases the money supply faster than the economy is growing, which causes inflation. In severe cases, this spiral gets out of control. The government needs more money, the central bank prints more, inflation rises, so the government needs even more money to cover the same real spending, so the central bank prints more, and you end up with what economists call hyperinflation. We'll dedicate a full chapter to hyperinflation later because it's one of the most extreme and instructive phenomena in all of monetary history. But the key point right now is inflation is the enemy of currency value, and the institutions that fight inflation are among the most important determinants of whether a currency holds its worth over time. Section 3. Interest rates and the global hunt for yield. Here's a question. If you had $1 million to invest, and country A was offering 5% annual returns on its government bonds, while country B was offering 1%, where would you put your money? Country A, obviously. The math is simple. Now multiply that decision by millions of investors, pension funds, sovereign wealth funds, insurance companies, and hedge funds, all making similar calculations simultaneously, and you start to understand how interest rates drive currency values. When a country raises its interest rates, it makes its currency-denominated assets more attractive. Investors from around the world convert their own currencies into that country's currency to buy those higher-yielding assets. That surge of demand for the currency pushes its value up. Conversely, when a country cuts its interest rates, the returns on its assets become less competitive, capital flows out toward better yields elsewhere, and the currency weakens. This mechanism, called the interest rate differential effect, is one of the primary reasons why central bank decisions move currency markets so dramatically. When the US Federal Reserve holds a meeting and raises interest rates by a quarter point, you will see the dollar move within seconds of the announcement. Traders have positioned themselves in advance, models have been running scenarios, and the second the decision is made, billions of dollars of currency transactions execute automatically. The speed and sensitivity of modern currency markets to interest rate decisions is genuinely remarkable. The strategy of borrowing in a low interest rate currency to invest in a high interest rate currency has its own name in financial markets. the carry trade, and it can be enormously profitable when it works. For many years, investors borrowed in Japanese yen because Japan kept interest rates near zero for decades, and invested in higher-yielding currencies like the Australian dollar or various emerging market currencies. As long as the exchange rate stayed relatively stable, the returns were essentially free money. Borrow cheap, invest at a premium, pocket the difference. Except, of course, there's no such thing as free money. The carry trade works beautifully in calm markets, and then it blows up spectacularly in turbulent ones. When markets get nervous, when some global risk event triggers a flight to safety, carry trade positions unwind rapidly. Everyone rushes to pay back their yen loans at the same time, which drives the yen sharply higher, which makes the yen loans more expensive in local currency terms, which forces more unwinding, which drives the yen higher further. A vicious, self-reinforcing loop. Several significant market dislocations in the past 2 decades have been heavily shaped by carry trade unwinding, including a memorable episode in August 2024, where the yen strengthened sharply over a matter of days, causing cascading losses across global markets. The carry trade episode illustrates something crucial about interest rates and currencies. The relationship isn't just about where rates are, but about where markets expect them to go. Currency. Traders are essentially constantly running probability distributions on future central bank decisions. They're asking, is this central bank going to cut rates at its next meeting? Raise them? By how much? What does the economic data imply about their likely path? What do the central bank officials' public speeches suggest? This forward-looking aspect means currency markets can move dramatically on data releases, monthly employment reports, inflation figures, GDP growth estimates, because those data points change expectations about future monetary policy. A surprisingly strong jobs report in the US doesn't just reflect well on the economy, it suggests the Fed might keep rates higher for longer, which strengthens the dollar immediately, even before any actual rate change happens. The sophistication and speed of this forward-looking behavior means that currency markets are often said to be among the most efficient in the world, meaning they incorporate new information almost instantly. Which also means they're incredibly hard to consistently beat. The smartest people in finance, with the most sophisticated models and the best data, still lose money on currency speculation with disturbing regularity. The market is not always right, but it is always fast. Section 4. Trade balances and the currency demand they create. Let's go back to basics for a moment, because trade is one of those fundamental forces that gets obscured by all the financial complexity layered on top of it. When Japan sells a Toyota to an American buyer, the actual financial mechanics, in simplified form, look like this. The American buyer has dollars, but Toyota wants to be paid in yen, because yen is what Toyota uses to pay its Japanese workers, Japanese suppliers, and Japanese taxes. So somewhere in the transaction, someone exchanges dollars for yen. The demand for yen goes up. Yen strengthens slightly relative to the dollar. Now multiply that by millions of Toyota sales, millions of Sony electronics purchases, millions of Panasonic products shipped to American retailers, millions of Japanese machine tools sold to American manufacturers. The aggregate demand for yen, driven by this trade, is a constant upward pressure on the Japanese currency. Japan has run a large trade surplus with the United States for decades. America buys far more from Japan than Japan buys from America. The result is a persistent flow of demand for yen, foreigners needing yen to pay for Japanese goods. That tends to support the yen's value. The same logic applies globally. Trade surplus countries, China, Germany, South Korea, Japan, see their currencies supported by the ongoing demand from countries that need those currencies to buy their exports. Trade deficit countries, the United States being the supreme example, see an ongoing outflow of their currency as they purchase more from abroad than they sell. In theory, this should weaken the deficit countries' currency. In theory, the United States, as we noted in the intro, has a persistent, enormous trade deficit and a strong currency, which seems to contradict this logic. We'll explain that paradox fully when we get to the reserve currency chapter. For now, just note that trade flows are one significant input into currency demand. Important, real, and consequential, but they aren't the only input, and sometimes other forces dominate. One thing that does reliably happen with trade imbalances is political tension. Countries that run persistent surpluses attract accusations of cheating, of deliberately keeping their currency undervalued to make their exports artificially competitive. This is the currency manipulation charge that comes up repeatedly in US-China trade discussions, and it's worth understanding what's actually being alleged. If a country intervenes in currency markets, buying foreign currency with its own currency, effectively increasing the supply of its own currency and the demand for foreign ones, it can push its exchange rate lower than market forces would otherwise dictate. A weaker currency makes exports cheaper for foreign buyers, boosting exports. It also makes imports more expensive for domestic consumers, discouraging them from buying foreign goods. Net result: bigger trade surplus, more growth, more jobs in the export sector. This sounds great for the currency manipulator, and in some ways it is, at least in the short run, but it has costs too. Imports are more expensive, so domestic consumers pay more for foreign goods. Inflation tends to rise. The gains in the export sector come partly at the expense of domestic consumption, and it tends to provoke retaliatory measures from trading partners who don't appreciate having the terms of trade tilted against them by government intervention. The United States has repeatedly accused China of currency manipulation, with varying degrees of official formalization. China maintains that its exchange rate policies are legitimate responses to market conditions and development needs. The International Monetary Fund, which is supposed to referee these disputes, has largely sided with China in recent years, though the debate continues. The broader point: trade flows create currency demand. Trade imbalances create political friction, and the line between legitimate monetary policy and currency manipulation is often genuinely blurry rather than clear-cut. Section 5. Capital flows, the fast money. If trade flows are the slow, steady river that shapes currency values over time, capital flows are the flash floods. Trade is about goods and services, things that take time to produce, ship, and consume. Capital flows are about investment, money moving to wherever it can earn the best risk-adjusted return, moving at the speed of a mouse click. In the modern era of financial globalization, capital flows dwarf trade flows in terms of their scale and of their impact on exchange rates. The Bank for International Settlements estimates that the global foreign exchange market processes more than $7 trillion in transactions every single day. To put that in perspective, total global annual trade in goods and services is roughly $30 trillion, meaning the foreign exchange market turns over that entire amount in about 4 days. The vast majority of those transactions have nothing to do with trade. They're about capital flows, investment, speculation, hedging, carry trades, and portfolio rebalancing. This is why currencies can move sharply even when there's no obvious trade-related reason. A major pension fund decides to rebalance its portfolio, shifting a fraction of its assets from euros to dollars, and the resulting trade is large enough to move the exchange rate. A hedge fund takes a large speculative position betting on a currency to weaken, and if enough other traders follow their signal, the currency actually does weaken, validating the bet. A geopolitical event causes investors to reassess the risk of holding assets in a particular currency, triggering rapid outflows, and the currency collapses almost overnight, even if the underlying economy hasn't changed. This is the world we live in, a world where the financial economy is vastly larger than the real economy, where currency values can be moved by decisions that have nothing to do with productivity, trade, or inflation, and where the line between economic reality and market perception has become genuinely difficult to draw. It also creates a particular kind of vulnerability for smaller economies. When global capital is flowing freely and investors are in a risk-seeking mood, money floods into emerging markets chasing higher yields. Their currencies strengthen, sometimes significantly. Then when sentiment shifts, when there's a global risk-off event, when the Fed raises US rates and makes dollar assets more attractive, when some regional crisis spooks investors, that money floods back out just as fast as it came in, and the currencies collapse. The country's economic fundamentals may not have changed at all, but the exchange rate can drop 20% or 30% in a matter of weeks. Economists call this the sudden stop problem, the abrupt reversal of capital inflows. And it has been responsible for some of the most severe economic crises of the past half-century. We'll look at specific examples in later chapters, but the pattern is devastatingly consistent. Capital flows in during good times, flattering the currency and the economy. Capital flows out in bad times, crushing the currency and triggering economic crisis. The very openness to international capital that helps emerging economies grow also makes them vulnerable to these violent reversals. This is one reason why economists continue to debate how open countries should be to international capital flows. The standard economic consensus for much of the 1990s was that full capital account liberalization, letting money flow freely across borders, was unambiguously good. Then a series of spectacular crises in Asia, Russia, and Latin America, all involving sudden stops and currency collapses, prompted a reassessment. Today, the view is more nuanced. Some capital account openness is beneficial, but unlimited, unmanaged capital flows create risks that countries need to be prepared for. The countries that have navigated this best are often those with large foreign exchange reserves, stockpiles of dollars, euros, gold, and other reserve assets that they can deploy to defend their currencies when capital flows suddenly reverse. China, for example, has accumulated the world's largest foreign exchange reserves, at peak more than $4 trillion, precisely as insurance against the kind of sudden capital flight that has devastated other emerging economies. Section 6. The Psychology of Markets, because humans are complicated. Here's the thing that economic models often underappreciate. Currency markets are made of people, and people are not rational calculating machines. They panic, they get greedy, they follow the herd, they respond to narratives and stories, not just data. George Soros, the legendary hedge fund manager, famously broke the Bank of England in 1992 by betting massively against the British pound. The pound was at that point pegged to the German mark as part of the European exchange rate mechanism, a precursor to the euro. The peg required Britain to maintain interest rates high enough to keep the pound at a fixed value relative to the mark, even though Britain's economy was struggling, and those high interest rates were causing real damage. Soros recognized that the peg was fundamentally unsustainable. Britain couldn't afford to keep interest rates high enough to defend it indefinitely. At some point, economic reality would force a devaluation. He borrowed billions of pounds and sold them short, betting that the pound would fall. His selling, combined with that of other speculators who followed his lead, created massive pressure on the pound that the Bank of England couldn't withstand, even by spending billions of dollars of reserves to buy pounds and support the price. Eventually, Britain withdrew from the ERM, the pound was devalued, and Soros reportedly made about $1 billion in a single day. The lesson of Black Wednesday, as it became known, is not just about economic fundamentals, it's about the power of market expectations and the self-fulfilling nature of currency crises. Once enough people believe a currency is going to fall, they act in ways, selling the currency, betting against it, that help make the fall happen. The belief creates the reality. This is what economists call a self-fulfilling speculative attack, and it's a phenomenon with no real equivalent in most other markets. Market psychology also shapes currencies through something called risk. Appetite, the general mood among global investors regarding how much risk they're willing to take. In periods of high-risk appetite, investors move money into higher-risk, higher-reward assets, emerging market currencies, commodities, equities. In periods of low-risk appetite, when something frightening happens in the world, they retreat to safe haven assets, US dollars, Swiss francs, Japanese yen, gold. These safe haven currencies tend to strengthen in crises, even if the crisis has nothing directly to do with those economies. This is why, counterintuitively, the US dollar often strengthens during American financial crises. The 2008 global financial crisis, started in the United States, was caused by American financial institutions and devastated the American economy. And yet the dollar strengthened significantly during the worst of it. Why? Because when the world gets scared, it runs to dollars. It's reflexive. The dollar has been the world's safe haven for so long that it's become a self-reinforcing habit. Even when the US is the source of the crisis, the dollar benefits from the flight to safety. Understanding this psychological dimension of currency markets is essential for understanding why exchange rates sometimes move in ways that seem to make no sense. The pound falling after the Brexit referendum, even though Britain's economic fundamentals didn't change overnight. the Turkish lira collapsing after political statements that spooked investors about the independence of the central bank, the Argentine peso in free fall as investors lost confidence in the country's ability to manage its debt. In each of these cases, what changed first was perception, the narrative that markets told themselves about the currency's prospects, and reality followed. Section 7. The Impossible Trinity. Why governments can't have everything they want. One of the most elegant and important concepts in international economics is something called the Impossible Trinity, also known as the Mundell-Fleming trilemma. It sounds arcane, but it captures something profound about the limits of what governments can actually control. The Impossible Trinity states that a country cannot simultaneously have all three of the following: a fixed exchange rate, free capital movement, and an independent monetary policy. It can have any two of these three things, but not all three at once. If you try to have all three, the combination is inherently unstable and will eventually collapse. Here's why. Suppose you want a fixed exchange rate. You want your currency to trade at a set value against some other currency or basket of currencies. And you also want free capital movement. You want investors to be able to bring money in and take it out freely. Well, then you can't have independent monetary policy, because if your interest rates diverge from the rates needed to maintain the peg, say, your economy is struggling and you want to cut rates, but cutting rates would cause capital to flow out and break the peg, you're stuck. You can't cut rates without breaking the peg, and you can't maintain the peg without the capital flows that depend on keeping rates attractive. Alternatively, suppose you want an independent monetary policy. You want to be able to set interest rates according to your own economic needs, and you also want free capital movement. Then you can't have a fixed exchange rate, because your interest rate decisions will inevitably cause capital flows that push the exchange rate around. Or, suppose you want a fixed exchange rate and independent monetary policy. Then you can't have free capital movement. You need to control what capital comes in and goes out, restricting the flows that would otherwise undermine the peg. This trilemma shapes the choices of every country in the world. The Eurozone countries chose free capital movement and a fixed exchange rate relative to each other, and, therefore, surrendered independent monetary policy, handing it to the European Central Bank in Frankfurt. China has, for much of its modern history, maintained a managed exchange rate and independent monetary policy, and therefore has maintained capital controls limiting how freely money can flow in and out. The United States has independent monetary policy and free capital movement, and therefore has a floating exchange rate that goes wherever market forces take it. There's no right choice between these options. They reflect different priorities and different economic circumstances. But the Impossible Trinity makes clear that there are genuine trade-offs, and that the combination of all three goals is not available to anyone. Governments that try to ignore this reality, that try to maintain a fixed rate, open capital account, and independent policy simultaneously, eventually face a crisis that forces them to choose. Britain's 1992 ERM crisis was, in part, a story of the Impossible Trinity. Britain tried to maintain a fixed exchange rate, the ERM peg, free capital movement, London is the world's leading financial center, and independent monetary policy, setting rates for its own economy. The combination proved unsustainable, and the market forced the resolution. Putting it together. So here's the picture that emerges when you assemble all these building blocks. A currency's value is determined by a complex, dynamic interaction of fundamental economic factors, productivity, inflation, interest rates, trade balances, and more fluid psychological factors, market expectations, risk appetite, narratives, speculative attacks. The fundamental factors set the long-run trajectory. The psychological factors determine the path and can cause significant deviations from fundamentals that sometimes persist for years. Governments have some ability to influence all of these factors, but not unlimited ability. They're constrained by the impossible trinity by international capital flows they can't fully control, by the credibility of their institutions, and by the basic reality that markets have more money and move faster than any government or central bank can match indefinitely. What they can do is build the conditions under which trust in their currency can thrive: strong, independent institutions, consistent, credible policies, diversified, productive economies, sustainable fiscal positions, and the political stability that allows all of the above to persist over time. Countries that do these things reliably tend to have currencies that hold their value. Countries that don't, sooner or later, face the verdict of the market. That verdict can be slow, a gradual, decades-long decline in a currency's purchasing power, or it can be shockingly fast. In the next chapter, we're going to talk about what happens when things go genuinely wrong, when inflation doesn't just erode a currency's value gradually, but destroys it catastrophically, when a wheelbarrow full of cash really does buy only a loaf of bread, if you're lucky. We're going to talk about hyperinflation, and it is, in equal measure, one of the most disturbing and most instructive phenomena in all of monetary history. Chapter 2: When Money Goes Mad. The history and horror of hyperinflation. Let's set a scene. It's 1923. You're in Berlin. You've just received your weekly wages, a large stack of paper notes. Because paper notes are all there are, you stuff them into a bag, a suitcase actually, because there are a lot of them, and you rush to the market, not because you're excited about shopping, because you're racing against time. If you wait until tomorrow, those notes will buy half as much. If you wait until next week, a quarter. The longer you hold the money, the less it's worth, so everyone is spending as fast as they possibly can, which means everyone is rushing to the market at once, which means prices are rising faster, which means everyone is rushing even harder. At the market, you buy bread. The price has been written on a chalkboard, and someone is standing next to the chalkboard with a piece of chalk, updating the price every few hours. You hand over a stack of notes. The baker takes them without counting. Counting would take too long, and gives you a rough estimate of change. The change is already worth less than when you started the transaction. You walk home with your bread, feeling vaguely victorious. You got something real for your money, something you can eat. Your neighbor, the one who hesitated, who thought the prices would stabilize, who kept his savings in cash, he's ruined. His life savings will buy him a cup of coffee. Maybe. Welcome to hyperinflation, one of the most extreme and psychologically devastating phenomena in economic history, and one of the most instructive examples of what happens when the relationship between money and trust completely breaks down. Section 1. What hyperinflation actually is and isn't first. Some definitions. Because hyperinflation gets thrown around loosely by people who mean anything from prices went up a lot to the genuine history-altering catastrophe we're about to describe. Economists generally define hyperinflation as inflation exceeding 50% per month, not per year, per month. At 50% monthly inflation, prices double roughly every 6 weeks. At that rate, something that costs 1 unit of currency in January will cost more than 100 units by December. That's the lower threshold. The most extreme historical episodes of hyperinflation make 50% monthly look modest. Normal high inflation, the kind that causes real economic damage and political crises, might run at 20, 30, even 100% per year. That's serious. It erodes purchasing power, hurts fixed income earners, distorts investment decisions, and causes enormous social strain. But it's manageable. People and businesses adapt. Wages adjust, contracts get indexed to inflation, and while everyone is poorer in real terms, the basic functioning of the economy continues. Hyperinflation is different in kind, not just degree. It's the point at which inflation becomes so fast and so unpredictable that the currency itself stops functioning as a medium of exchange. People start refusing to accept it. They revert to barter, trading goods directly for other goods. They switch to foreign currencies. They start pricing things in something stable. Gold, dollars, cigarettes, whatever holds value better than the local currency. The monetary system doesn't just malfunction, it collapses. And when the monetary system collapses, so does a great deal of the economic and social order that depends on it. Businesses can't plan. Long-term contracts become impossible because nobody knows what anything will be worth. Savings are wiped out. The middle class, which typically holds its wealth in financial assets like bank, deposits and bonds, is destroyed. Political radicalization tends to follow. Hyperinflation has a way of making people very angry, very desperate, and very receptive to demagogues who promise simple solutions to complex problems. The connection between the hyperinflation of 1920s Germany and the political conditions that allowed the rise of National Socialism is real and well documented. The destruction of the German middle class, the savings wipeout, the humiliation of watching a lifetime of prudent saving become worthless, created a reservoir of rage and desperation that authoritarian movements were able to exploit. This is not to say that hyperinflation mechanically causes fascism, but it creates conditions in which extreme political movements can thrive. The lesson is worth remembering. Section 2. Weimar Germany, the hyperinflation that defined the term. The German hyperinflation of 1921 to 1923 is the most famous hyperinflationary episode in history, and for good reason. It was spectacular, it was devastating, and it happened in what had been one of the most sophisticated industrial economies in the world. If it could happen in Germany, people realized, it could happen anywhere. The roots of the crisis go back to World War I. Germany, like all the major powers, had financed the war largely by borrowing and by printing money. The gold standard, which had constrained currency creation before the war, was suspended. By the time the war ended in 1918, Germany was deeply in debt, its economy shattered, its infrastructure damaged, and its government deeply unpopular. Then came the Treaty of Versailles, which imposed massive war reparations on Germany. The exact amounts were disputed and revised multiple times, but the initial demands were staggering, equivalent to many years of Germany's total economic output. Germany was supposed to pay these reparations in gold or foreign currency, not in its own marks. This created an immediate problem. How do you acquire gold and foreign currency? You need to export more than you import, building up a surplus. But Germany's economy was in ruins, and its export capacity was severely damaged. The German government's response to this impossible situation was, essentially, to print money. When it couldn't meet its obligations in gold, it printed marks, used them to buy gold and foreign currency on the market, and paid with that. But this created exactly the vicious cycle you'd expect. Printing marks increased the supply of marks, which drove down their value, which meant you needed to print even more marks to buy the same amount of gold, which drove down their value further. Things got dramatically worse in January 1923, when France and Belgium occupied the Ruhr, Germany's industrial heartland, claiming that Germany had defaulted on its reparations obligations. The German government responded by calling for passive resistance. Workers in the Ruhr were encouraged to go on strike rather than work for the occupiers. The government continued to pay the striking workers with newly printed money. This was the moment when the inflationary crisis tipped into hyperinflation. The numbers from this period are so extreme they almost stop registering as real. In January 1921, $1 US was worth about 60 marks. Inflation was high, but not yet catastrophic. By November 1921, a dollar bought 330 marks. By July 1922, 670 marks. By January 1923, 17,000 marks. By July 1923, 350,000 marks. By September 1923, 98 million marks. By November 1923, the month the crisis peaked, $1 was worth approximately 4.2 trillion marks. Let that land for a second. $1, 4.2 trillion marks. In less than 3 years. The practical consequences were extraordinary. Workers were paid twice daily and given time off at lunch to rush out and spend their wages before they lost more value. Prices in restaurants were changed between when you ordered and when you finished eating. You were supposed to order and pay simultaneously to avoid this problem. Paper currency became literally worthless faster than it could be printed, so the Reichsbank began printing on only one side of notes to save time. At the peak, the printing presses were running around the clock and still couldn't keep up with the demand for physical currency. Some people, interestingly, did very well during the hyperinflation. Anyone who had borrowed money in marks and could repay it in devalued marks effectively had their debts wiped out. Real estate owners, agricultural landowners, manufacturers who could convert their income into real assets quickly, these groups often survived or even prospered. The losers were savers, particularly the middle-class Germans who had scrimped and saved in bank accounts and government bonds, believing they were being prudent. Their savings became worthless. Their prudence became their downfall. The psychological impact of this The sense of betrayal, of the entire social contract having been violated, was profound and lasting. The crisis was eventually ended by a remarkable piece of monetary engineering. In November 1923, the German government introduced a new currency, the Rentenmark, pegged at the rate of 1 Rentenmark to 1 trillion old marks. The Rentenmark was nominally backed by mortgages on German agricultural land and industrial assets. There was no gold because Germany had no gold left. But its real backing was credibility. A credible commitment by the new monetary authority to limit the supply of the currency and not repeat the mistakes of the past. Remarkably, it worked. Confidence returned. Hyperinflation ended almost immediately, which illustrates again how much of monetary stability is about psychology and trust. Section 3, Zimbabwe, a modern masterclass in how not to run a currency. If Weimar Germany is the 20th century's defining hyperinflation, Zimbabwe is the 21st century's, and in some ways, it's even more extreme. Zimbabwe's hyperinflation was the culmination of a long economic and political crisis that unfolded over decades. The country had been relatively prosperous at independence in 1980, with a diversified agricultural economy and a functioning financial system. But a combination of political mismanagement, land reform policies that devastated commercial agriculture, government spending that far exceeded revenues, and international sanctions combined to create an economic catastrophe. By the early 2000s, Zimbabwe was in deep recession. Food production had collapsed. Foreign exchange reserves were depleted. The government was running large deficits that it financed by printing money. Inflation began rising, and as it rose, the government's revenues, collected in rapidly depreciating currency, bought less and less in real terms. So the deficits got larger, so more money was printed, so inflation rose further. The spiral accelerated over the second half of the 2000s in a way that makes the German hyperinflation look almost gradual by comparison. By 2008, Zimbabwe was experiencing monthly inflation rates that are almost impossible to conceptualize. The International Monetary Fund estimated that at the peak, November 2008, Zimbabwe's annual inflation rate was approximately 89.7 sextillion%. That's 89,700,000,000,000,000,000,000,000,000,000,000,000% per year. At this rate, prices were doubling roughly every 24 hours. Banknotes became obsolete before the ink was dry. The Reserve Bank of Zimbabwe responded by issuing notes with ever larger denominations. First millions, then billions, then trillions. Eventually, a $100 trillion note was issued. It was worth, at the official exchange rate, roughly $3. On the parallel black market, significantly less. The photographs from this period are extraordinary and deeply strange. Stacks of cash that would fill a room required to buy basic groceries. Markets where prices were quoted in multiples of billions of dollars. Shops with empty shelves because nobody could price goods in a way that made economic sense when prices were changing hourly. Workers demanding to be paid multiple times per day, people abandoning Zimbabwean dollars entirely and insisting on payment in US dollars, South African rand, or goods, basically anything other than their own currency. The practical effects were devastating. The formal economy essentially ceased to function. Businesses couldn't operate. Banks became irrelevant because deposits lost value faster than interest could accumulate. The professional and middle class fled the country in enormous numbers. Doctors, engineers, teachers, accountants, because they couldn't earn a meaningful living. Healthcare collapsed, education collapsed. Life expectancy, which had already fallen sharply due to the AIDS crisis, declined further. The resolution came in 2009 when the government simply abandoned the Zimbabwean dollar and allowed the economy to dollarize, to use US dollars and other foreign currencies as the primary medium of exchange. There was no formal redenomination, no replacement currency introduced. People just stopped using Zimbabwe dollars, the central bank stopped printing them, and the hyperinflation ended literally overnight because the currency causing the hyperinflation was no longer being used. Zimbabwe subsequently issued new currency versions multiple times, with varying degrees of success and failure. The country's monetary situation remained complicated and troubled for years after the initial crisis. But the core lesson was clear. When a government loses the ability and willingness to maintain basic monetary discipline, the consequences can be catastrophic in a very short space of time. Section 4. Hungary, 1946. The world record nobody wanted. Here's a piece of trivia that will astonish at roughly 100% of dinner. Tables, the worst hyperinflation in recorded history did not happen in Germany in the 1920s. It did not happen in Zimbabwe, it happened in Hungary in 1946, and it makes both of those episodes look almost moderate. Hungary had been devastated by World War II. A significant portion of its physical infrastructure had been destroyed. The country had been occupied and looted by both Nazi Germany and, subsequently, the Soviet Union. Agricultural and industrial production had collapsed. The government had no meaningful tax base because there was almost no economic activity to tax. The Hungarian pengo, the pre-war currency, began inflating rapidly as the government tried to finance reconstruction and meet Soviet reparation demands by printing money. And then it went completely off the rails. At the peak of Hungary's hyperinflation in July 1946, the monthly inflation rate was approximately 41.9 quadrillion %. Yes, that is a number that exists in actual economic history. Prices were doubling roughly every 15 hours. The Hungarian government issued a 100 quintillion pengo note. That's a 10 followed by 20 zeros, which was, at the time of issue, worth a fraction of a US cent. The government eventually introduced a new currency, the forint, in August 1946, setting it at a rate of 1 forint to 400 octillion pengo. That's 4, followed by 29 zeros. It was the most extreme currency redenomination in history by orders of magnitude. What's remarkable about Hungary's case is that the resolution was actually quite successful. The forint was introduced with strict monetary discipline, backed by international support from the US and Soviet occupiers who both had an interest in stabilizing the country. Hyperinflation ended. The economy rebuilt. Hungary went on to function as a coherent economy for decades, albeit under Soviet control. The Hungarian case demonstrates both the extremity of what hyperinflation can become, truly at the peak, almost, beyond human comprehension, and the relative speed with which it can be stopped if the political will and institutional framework exist to replace the failed currency with a credible one. Section 5. The modern cases, Venezuela and Argentina. Hyperinflation is not a relic of history. It is happening right now in the 21st century in countries that should, by any reasonable assessment of their resources and potential, be prosperous. Venezuela is the most dramatic recent case. The country sits atop the world's largest proven oil reserves. In better times, oil revenues funded significant social programs that genuinely improved living standards for many Venezuelans. But a combination of political mismanagement, corruption, economic policies that drove away private investment, and a catastrophic collapse in oil prices created a fiscal crisis that the government responded to in the now familiar pattern, by printing money. Venezuela's inflation began escalating sharply after 2014 and hit hyperinflationary levels around 2017. By 2018, the IMF estimated annual inflation at more than 1 million %. The bolívar, Venezuela's currency, became essentially worthless. The government redenominated it multiple times, lopping zeros off and creating new bolívars. But the underlying dynamics didn't change, so the new currency just inflated away again. The social consequences have been extraordinary. Venezuela has experienced one of the largest refugee crises in the Western Hemisphere, with millions of Venezuelans, estimates range from 7 to 8 million, having fled the country. Those who remain face chronic shortages of food, medicine, and basic goods. The economy has contracted by more than 80% from its peak, a collapse comparable in scale to wartime devastation in countries that weren't at war. Venezuela's crisis is particularly instructive because it illustrates how political dysfunction interacts with economic mismanagement to create hyperinflationary spirals. A government that controls both fiscal and monetary policy and that faces no meaningful checks on its behavior has both the motive and the means to print money. The motive is political survival. Printing money lets you pay public sector workers, fund social programs, and maintain the loyalty of key constituencies even when the underlying economy isn't generating the revenues to support these expenditures. The means is the printing press, and in modern economies, the digital equivalent. Argentina's case is slightly different, and in some ways more fascinating because it's a recurring story. Argentina has experienced hyperinflation multiple times in its modern history. It had devastating hyperinflation in the late 1980s under President Raúl Alfonsín, reaching more than 3,000% annually. It introduced the convertibility plan in 1991, fixing the peso 1-to-1 with the US dollar, which brought inflation under control spectacularly quickly. And then collapsed in 2001 in a crisis that was, in part, a consequence of that very fix. Argentina has been fighting elevated inflation ever since, regularly experiencing annual rates that put it in a different league from most of the world. In 2023 and 2024, Argentina's annual inflation again exceeded 200%. Not technically hyperinflation by the 50% per month definition, but devastating enough in its economic and social effects. The election of Javier Milei as president in late 2023, partly on a platform of radical monetary reform including dollarization, was a direct political consequence of decades of monetary mismanagement. What's remarkable about Argentina is that it's not a poor, undeveloped country. It has enormous natural resources, a well-educated population, sophisticated institutions, and a history of genuine prosperity. The persistent inflation crisis is not about a lack of capacity. It's about a political economy that has repeatedly failed to deliver the fiscal discipline and institutional independence needed to maintain monetary stability. The tragedy of Argentina's monetary history is that it's a fully avoidable catastrophe that keeps being not avoided. Section 6. What hyperinflation teaches us. So what can we learn from all of this? Beyond the obvious, don't print too much money, which is easy to say and harder to implement when you're a government facing impossible fiscal pressures. What are the deeper lessons? First, trust, once lost, is extraordinarily hard to rebuild. The countries that have suffered hyperinflation carry the scar for generations. Germany's hyperinflation of 1923, followed by the Great Depression, left a cultural imprint on German attitudes toward inflation that persists today. The Bundesbank, before the euro, was famously the most inflation-averse central bank in the world, to a degree that sometimes bordered on the pathological. This wasn't irrational. It reflected a deeply rooted cultural memory of what happens when monetary discipline fails. The European Central Bank, largely modeled on the Bundesbank, inherits this institutional DNA. Second, the people who suffer most in hyperinflation are rarely the ones who caused it. Political and economic elites often find ways to protect their wealth by holding assets in foreign currencies, by owning real property, by getting paid in ways that aren't denominated in the collapsing currency. The people who get wiped out are ordinary savers, fixed-income earners, pensioners, and the middle class, people who played by the rules, trusted the system, and got punished for it. This distributional injustice is part of what makes hyperinflation so politically explosive. Third, hyperinflation can end surprisingly quickly, but only if certain conditions are met. A credible new monetary framework, a new currency, a fixed exchange rate peg, or dollarization, combined with genuine fiscal adjustment and an institutional framework that prevents the same mistakes from recurring, can stop hyperinflation almost immediately. The German Rentenmark of 1923 and the Hungarian forint of 1946 both demonstrated this. The hard part isn't the technical monetary fix, it's creating the political conditions under which a credible fix becomes possible and sustainable. Fourth, the prerequisite for avoiding hyperinflation is institutional. Countries with genuinely independent central banks, strong rule of law, democratic accountability, and fiscal institutions that prevent governments from running perpetually unlimited deficits very rarely develop hyperinflation. It's almost entirely a phenomenon of institutional failure, of governments that can print money and have reasons to do so without facing meaningful constraints. This is why the most important investment any country makes in its long-term monetary stability is in the quality of its institutions. Not in economic growth per se, plenty of fast-growing countries have experienced hyperinflation. Not in natural resources, Venezuela and Zimbabwe are resource-rich. The critical variable is whether the political and institutional architecture creates credible constraints on monetary policy and whether those constraints hold when they're tested. Fifth, And this is perhaps the most unsettling lesson. Hyperinflation tends to be preceded by a long period of high but not yet hyperinflationary inflation, during which each escalation seems like it might stabilize, and experts repeatedly reassure that the worst is unlikely. By the time it's obvious that the situation has moved into hyperinflationary territory, enormous damage has already been done. The warning signs are usually visible well in advance, but the political economy of addressing them is extremely difficult. You have to impose austerity, remove monetary stimulus, and let the economy go through painful adjustment before the crisis forces you to do so in far worse circumstances. This is, unfortunately, a lesson that keeps needing to be relearned in country after country, generation after generation. The fact that we have recent, living examples, Venezuela, Argentina, suggests that human memory is shorter than economic lesson cycles, or that the political economy of avoiding monetary crises is genuinely, stubbornly difficult in ways that theory doesn't fully capture. Section 7. The flip side. Deflation's quiet danger. We've spent this chapter focused on inflation's extreme end, but before we move on, it's worth briefly noting that the opposite extreme, deflation or falling prices, has its own set of dangers, because the story of what makes currencies go wrong is not simply more inflation equals more bad. Deflation, a sustained broad decline in the general price level, sounds appealing at first. Cheaper prices. Who doesn't like that? But in practice, deflation creates a deeply destructive economic dynamic. When prices are falling, consumers and businesses have an incentive to delay purchases. Why buy something today when it will be cheaper tomorrow, and cheaper next month? This postponement of spending reduces demand, which causes businesses to cut production and employment, which reduces incomes, which reduces spending further, a deflationary spiral. More critically, deflation is devastating for debtors. When you borrowed money, you borrowed a specific nominal amount. Deflation makes each unit of currency more valuable, which means the real value of your debt increases. You owe more in real terms than you borrowed, even without making any additional mistakes. This was a central driver of the Great Depression. Debtors, from farmers to businesses to banks, were crushed by the rising real weight of their debts as prices fell. Mass bankruptcies followed. Japan has spent much of the past 3 decades fighting mild deflation or near zero inflation, what economists call deflation risk, with generally disappointing results. The economy has stagnated, growth has been weak, and despite enormous monetary stimulus, getting inflation up to the central bank's 2% target proved persistently difficult. The lost decades of Japanese stagnation are, in part, a story of what happens when an economy tips into a low-growth, low-inflation trap from which escape proves elusive. The ideal, from a currency value perspective, is moderate, stable, predictable inflation, typically around 2% in developed economies. This is low enough that it doesn't significantly erode purchasing power, but high enough to prevent the deflationary dynamic from taking hold. The 2% target that most major central banks use isn't arbitrary. It represents decades of research and experience about what level of inflation keeps an economy running smoothly without the risks associated with either extreme. Getting to that sweet spot, and staying there, is the central challenge of monetary policy, and the currencies that represent economies where central banks have credibly achieved that, where inflation has been reliably low and stable for years or decades, are, unsurprisingly, the most trusted and most valuable currencies in the world. The takeaway: money needs a leash. Hyperinflation, in the end, is the story of what happens when money has no leash. When the entity with the power to create it has unlimited ability and sufficient incentive to do so, and when the institutional constraints that normally prevent excess are absent or overwhelmed, it is the most extreme demonstration of the fundamental truth we established at the beginning of this video. Money is a collective trust mechanism. When that trust is maintained, when money is scarce enough to hold value, when the institutions managing it are credible and constrained, it functions beautifully, enabling the complex web of transactions and specialization that makes modern economies work. When that trust is destroyed, when money becomes so abundant and so rapidly devalued that nobody wants to hold it, the entire economic system built on it collapses. The currencies we trust the most in the world today are the ones backed by the strongest institutional frameworks for maintaining that trust, and the most trusted of all, the one that sits at the apex of the entire global monetary system, is the subject of our next chapter, the US dollar. How a currency from a country that didn't exist 250 years ago became the world's indispensable currency. How it benefits from a privilege that is, when you really examine it, almost absurdly advantageous, and why the rest of the world has, for decades, been simultaneously dependent on it and resentful of it. That story, the story of how the dollar became king, is one of the most fascinating in all of economic history, and it involves, among other things, a hotel in New Hampshire, a president going off the gold standard in a live television address, and the concept of petrodollars, which sounds like something from a science fiction novel but is very real and very important. Let's get into it. Chapter 3, The King Dollar, How America's Currency Conquered the World. There is a small town in the state of New Hampshire called Bretton Woods. Population, a few hundred people. No major industry, no particular geographic distinction, the kind of place you drive through without noticing. And yet, in the summer of 1944, this obscure mountain hamlet hosted a meeting that would determine the architecture of the global monetary system for decades to come, and whose consequences are still shaping the world economy today. The Bretton Woods Conference, formerly known as the United Nations Monetary and Financial Conference, brought together 730 delegates from 44 allied nations. They gathered at the Mount Washington Hotel, a grand, white colonnaded resort that had seen better days and would, somewhat appropriately, fall into disrepair after the conference before being eventually restored. They came to answer a question that the chaos of the previous 3 decades had made urgently necessary. What should the international monetary system look like after the war? The previous system had failed catastrophically. The gold standard, which had provided reasonable monetary stability in the pre-WWWI era, had been progressively abandoned during and after that war, reinstated in various patched-together forms during the 1920s, and then definitively collapsed during the Great Depression as countries one by one abandoned their gold pegs to pursue independent monetary policies. The result was competitive devaluations, countries deliberately weakening their currencies to make their exports cheaper and their neighbors' exports more expensive, a race to the bottom that the press called beggar thy neighbor policies. International trade contracted, economic nationalism surged, and into the political vacuum created by economic devastation stepped authoritarian movements of precisely the kind we discussed in the hyperinflation chapter. The delegates at Bretton Woods were determined not to repeat those mistakes. They needed a new international monetary framework, one that provided exchange rate stability without the rigidity of the pure gold standard, that facilitated international trade and investment, and that could accommodate the legitimate need of individual countries to pursue their own economic policies. The solution they arrived at was, in retrospect, a reflection of a very specific moment in history, a moment when the United States was not just the largest economy in the world, but by far the dominant one, in a way it has never been before or since. Section 1. The moment America became everything. To understand why the dollar became the world's reserve currency, you have to understand what the United States looked like in 1944. Europe was devastated. The Soviet Union had lost somewhere between 20 and 27 million people and had huge portions of its territory in ruins. Britain, though on the winning side, was essentially bankrupt. It had liquidated most of its overseas investments and run up enormous debts financing the war. France had been occupied for 4 years. Germany, Italy, and Japan were in ruins, and would be even more so when the war ended the following year. The United States, by contrast, had entered the war late, fought it largely overseas, and had not had its territory invaded or its cities bombed. More importantly, the wartime economy had transformed the U.S. from a nation still recovering from the Depression into the most productive manufacturing economy the world had ever seen. American factories were producing planes, ships, tanks, guns, trucks, and food at a rate that staggered contemporaries. American workers were employed at full capacity. American farms were feeding both domestic populations and allies. By the end of the war, the United States accounted for roughly half of the entire world's economic output. Not 20%, not 30%, approximately half. It held roughly 2/3 of the world's monetary gold reserves. Its industrial base was intact and humming. Its currency was sound. Its institutions were functioning. In a world where every other major economy was either destroyed or severely damaged, America was, quite simply, the only game in town. In this context, the Bretton Woods Agreement made a kind of obvious sense. The new international monetary system would be anchored to the US dollar, which would be the one currency directly convertible to gold at a fixed rate of $35 per ounce. Every other currency would be pegged to the dollar at a fixed exchange rate with the ability to adjust that rate only under conditions of fundamental disequilibrium and with approval from a new international institution, the International Monetary Fund, also created at Bretton Woods. A second institution, the International Bank, for Reconstruction and Development, now known as the World Bank, would provide financing for post-war reconstruction. The genius of the system, from America's perspective, was that it made the dollar the linchpin of the entire global monetary order without requiring America to give up meaningful policy flexibility. Every other country was disciplined by the need to maintain their peg to the dollar. America was only disciplined by the gold convertibility commitment, and as long as other countries didn't actually demand gold for their dollars, that constraint was theoretical rather than practical. The system worked remarkably well for about 25 years. International trade expanded. Europe and Japan rebuilt, with substantial American assistance through the Marshall Plan and other programs. Exchange rates were stable. The global economy grew rapidly. The period from roughly 1950 to 1973 is sometimes called the Golden Age of Capitalism and the Bretton Woods. Monetary system was one of the foundations on which that Golden Age rested, but there was a flaw built into the system from the beginning, and a sharp-eyed economist named Robert Triffin identified it in 1960 in what became known as the Triffin Dilemma. Section 2. The Triffin Dilemma, a problem built into the foundation. Here's the problem Triffin saw. For the Bretton Woods system to function, the rest of the world needed dollars. International trade was conducted in dollars. Foreign exchange reserves were held in dollars. Countries needed dollar liquidity to maintain their pegs and to finance their trade. The only way for the rest of the world to accumulate the dollars it needed was for the United States to run balance of payments deficits, to send more money out of the country than it took in by importing more than it exported, by investing overseas, by spending on military bases and foreign aid. If America ran surpluses, if it took in more than it sent out, dollars would become scarce globally and the system would seize up. But here's the dilemma. The more dollars America sent into the world to satisfy global demand, the larger the gap grew between the dollars in circulation globally and the gold backing those dollars. America had promised to convert dollars to gold at $35 per ounce. But as dollar balances abroad grew, and as America's gold reserves didn't grow proportionally, the ability to actually honor that promise became increasingly questionable. Countries started to notice. France under Charles de Gaulle, who had a particular gift for being a thorn in America's side, was especially vocal about what he called America's exorbitant privilege. France sent ships across the Atlantic to collect physical gold in exchange for its dollar holdings, literally cashing in the promise. If everyone did that, America would run out of gold quickly. By the late 1960s, the system was visibly under strain. The Vietnam War was enormously expensive and was financed partly by deficit spending, increasing the supply of dollars. American inflation was rising. Other countries were importing that inflation through their dollar pegs. Speculation against the dollar grew. Gold markets were destabilized. The official $35 per ounce price was increasingly divorced from where gold would trade in free markets. Something had to give. And on the evening of August 15, 1971, Richard Nixon went on national television to announce that it had Section 3, Nixon's Sunday night surprise. The announcement was made on a Sunday night, deliberately chosen to preempt Monday morning's opening of foreign exchange markets in Asia before they could react. Nixon had spent the weekend at Camp David with his economic advisors, hammering out a decision that they knew would shock the world. The centerpiece of what became known as the Nixon shock, the United States was immediately suspending the convertibility of the dollar to gold. The commitment at the heart of the Bretton Woods system, The promise that dollars could be exchanged for gold at $35 per ounce was gone. Just like that, 44 nations had built their monetary systems around that promise, and it was unilaterally abrogated in a 15-minute television address. Nixon packaged the announcement with other measures, wage and price controls to fight inflation, a temporary import surcharge, and framed it as defending the dollar against international money speculators. The rhetoric was populist and the framing was somewhat misleading about the actual causes of the problem, but the decision itself was, under the circumstances, probably unavoidable. The system had become untenable. The Bretton Woods system of fixed exchange rates didn't survive Nixon's announcement by long. There were various attempts to patch it. The Smithsonian Agreement of December 1971, which tried to reestablish fixed rates at new parities, but the fundamental architecture was broken. By 1973, most major currencies had moved to floating exchange rates, and the Bretton Woods era was definitively over. Here's where you might expect the story of dollar dominance to end. The gold backing is gone. The fixed exchange rate system is gone. The special status of the dollar seems to have no remaining institutional basis. Other currencies, the Deutschmark, the yen, the pound, could in theory compete equally for the role of international reserve currency. And yet, something remarkable happened. The dollar didn't just survive as the world's dominant reserve currency, it consolidated its dominance. The percentage of global foreign exchange reserves held in dollars actually increased in the years after Bretton Woods. The dollar continued to be the currency in which most global trade was invoiced, in which most commodity markets were priced, in which most international loans were denominated. The institutional architecture had collapsed, but the dollar's preeminence survived. Why? The answer involves oil, OPEC, and a deal that Henry Kissinger negotiated with Saudi Arabia that is one of the most consequential and least discussed agreements in modern economic history. Section 4. Petrodollars, the deal that kept the dollar on top. The oil price shock of 1973, when OPEC quadrupled oil prices following the Yom Kippur War, created an enormous new flow of money. Oil exporting countries were suddenly accumulating massive revenues. The question of what currency those revenues would be denominated in and what currency would be used to price oil globally was of enormous strategic importance. If oil, the lifeblood of industrial economies, was priced in dollars, then every country in the world that needed oil, meaning essentially every country in the world, needed dollars to buy it. This would create a structural, ongoing global demand for dollars that would support the currency's value. Regardless of what happened to Bretton Woods or America's trade balance, the Nixon and Ford administrations, with Kissinger as the key architect, negotiated a series of agreements with Saudi Arabia, the dominant player in OPEC, in 1974 and 1975. The details of these agreements have been partly shrouded in secrecy, but the broad outlines are known. In exchange for American security guarantees, military equipment sales, and political support, Saudi Arabia agreed to price its oil exports exclusively in US dollars and to invest a significant portion of its petroleum revenues in US Treasury securities. Other OPEC members followed Saudi Arabia's lead. The petrodollar system was born. The consequences were profound and far-reaching. Every oil-importing country, Japan, Germany, France, Britain, India, China, Brazil, everyone, needed to maintain significant dollar reserves to pay for oil. The dollar became not just the reserve currency of central banks, but the operational currency of global energy markets, the most economically critical commodity market in the world. This created exactly the structural demand for dollars that the post-Bretton Woods dollar needed. American deficits, which produced dollars that flowed out into the world, were matched by a global need to hold those dollars to buy oil. The vicious circle that Triffin had identified became, in a way, a virtuous one. America ran deficits, dollars flowed out, countries needed those dollars for oil, so they recycled them into dollar-denominated assets like U.S. Treasury bonds, which helped finance American deficits, which produced more dollars, which were needed for oil. It's a system that, viewed from a certain angle, looks almost too convenient for America. And that's not an accident. Section 5. The exorbitant privilege. What reserve currency status actually means. De Gaulle's phrase, exorbitant privilege, deserves a much closer examination because it captures something that most people don't fully appreciate about what it means for a country's currency to be the global reserve currency. Start with the most basic benefit. When the US government needs to borrow money, it issues treasury bonds. The global demand for dollar-denominated assets, driven by the reserve currency role, means that there is an enormous structural pool of buyers for those bonds. Foreign central banks, sovereign wealth funds, international financial institutions, all of which need to hold dollar assets as part of their reserve management. This demand keeps U.S. borrowing costs lower than they would otherwise be. America pays less interest on its national debt than it would if the dollar were just another currency. How much lower? Economists have tried to estimate the privilege in dollar terms, with estimates varying widely, but studies have suggested it amounts to something between 0.5 and 1.5 percentage points lower interest rates across the maturity spectrum. On a national debt of $30+ trillion, even half a percentage point represents enormous annual savings, hundreds of billions of dollars that America doesn't have to pay in interest. But the financial benefit goes further. Because global trade is predominantly invoiced in dollars, American companies can conduct international business in their own currency. They don't face the exchange rate risk that companies from other countries face. A German company selling to Japan has to manage the euro-yen exchange rate. An American company selling to Japan just prices in dollars, and the Japanese buyer bears the exchange rate risk. This reduces costs and simplifies international business for American firms in ways that are diffuse but real. More dramatically, the reserve currency status means that America can run sustained trade deficits without the currency crisis that would afflict any other country doing the same, normally a country that imports far more than it exports. Sees its currency weaken because it's selling its currency to buy foreign goods, creating downward pressure. But because foreigners need dollars for trade and reserves regardless of America's trade balance, the dollar is supported by this structural demand even when America is a persistent, large-scale importer. America can consume more than it produces, and the rest of the world finances that consumption by accepting dollars in exchange. This is the mechanism that has allowed the United States to run trade deficits for essentially the entire period since the 1970s without facing the currency crisis that theory would predict. It's what makes the dollar's situation genuinely anomalous in the history of international economics, and it's why the rest of the world, particularly emerging market economies and China, views the dollar's dominance with a mixture of resentment and grudging acceptance. The resentment is understandable. The reserve currency system, as currently structured, means that America gets to run deficits that other countries can't. It means that when the Federal Reserve makes monetary policy decisions, raising or cutting rates to manage the American economy, those decisions reverberate through exchange rates and capital flows in ways that can be deeply disruptive for other countries that had no say in the decision. When the Fed raises rates, capital flows out of emerging markets and into dollar assets, weakening their currencies and sometimes triggering crises. When the Fed cuts rates, hot money floods into emerging markets, inflating asset bubbles that eventually burst. The Fed is managing for America. Everyone else has to manage the consequences. This is what economists call the dollar dilemma for global monetary governance. The reserve currency country needs to supply the world with its currency, which means running deficits. But running deficits over the long run is supposed to weaken a currency. The resolution of this apparent paradox is that the structural demand for dollars, driven by the reserve currency role, is large enough to offset the downward pressure from deficits, but it creates a system that gives America enormous advantages while imposing real costs on others. Section 6. The dollar's competitors. Why nobody has managed to replace it. If the dollar's dominance creates so many problems and so much resentment, why hasn't another currency replaced it? This is a question economists, policymakers, and geopolitical strategists have been asking and trying to engineer answers to for decades. Several candidates have presented themselves over the years, and it's worth examining each one. The euro was, when it launched in 1999, widely expected to eventually challenge the dollar's reserve currency status. The eurozone represented a massive, sophisticated economy comparable in size to the United States. The euro would be backed by the collective credibility of European institutions, particularly the inflation-fighting credentials of the German Bundesbank, which was the model for the ECB. There was no obvious reason why the euro couldn't become an alternative global reserve currency, giving the world a choice. And to a degree this has happened. The euro is the world's second largest reserve currency, accounting for roughly 20% of global foreign exchange reserves compared to the dollar's 58 to 60%. It's widely used in international trade and finance, particularly in Europe's own neighborhood, but it hasn't come close to challenging the dollar's primacy. And the financial crises of 2010 to 2012, when the eurozone itself seemed to be at risk of fragmenting, severely damaged confidence in the euro as a reserve asset. A reserve currency needs to be from an issuer that credibly will always exist. During the Greek crisis, will the eurozone survive was not a hypothetical question. That existential uncertainty is not something that afflicts the dollar. The Japanese yen had its moment in the late 1980s when Japan's economy was booming, and many commentators expected Japan to eventually surpass the United States. The Japan is number one thesis had serious academic proponents, but Japan's asset price bubble collapsed in the early 1990s, the country entered its long stagnation, and the yen's role in global finance, while significant, never expanded to challenge the dollar. The Chinese yuan is the most serious current challenger, and it's worth extended examination. China has the world's second largest economy and is the world's largest trading nation. It would seem natural that its currency should play a major international role commensurate with its economic weight. China has been actively working to internationalize the yuan for roughly 15 years. It has established yuan swap lines with dozens of central banks. It has encouraged the use of yuan in bilateral trade agreements. It has pushed to have the yuan included in the IMF's special drawing rights basket, which happened in 2016. It has launched the Petro-Yuan initiative, trying to get oil traded in yuan rather than solely in dollars. It has built the cross-border interbank payment system as an alternative to the dollar-dominated SWIFT network. And yet, the yuan's share of global foreign exchange reserves remains tiny, around 2 to 3%. The yuan is barely used in international trade outside of transactions with China itself. Despite all of China's efforts and ambitions, the dollar's dominance has not been meaningfully eroded. Why? The answer comes back to trust and institutions, and to the impossible trinity we discussed in Chapter 1. For a currency to serve as a true global reserve currency, you need to be willing to let capital flow freely in and out, because countries holding your currency as a reserve need to be able to use it freely. But China maintains capital controls. You can't freely move money in and out of China. This is a fundamental barrier to the yuan becoming a true reserve currency. China maintains capital controls for good reasons. They protect against the kind of sudden capital flight that devastates other emerging economies, and they give the People's Bank of China more control over domestic monetary conditions. But you can't have capital controls and a reserve currency at the same time. The impossible trinity strikes again. More fundamentally, reserve currency status requires that foreign holders trust not just that the currency will hold its value, but that they will always be able to access their assets. This means confidence in rule of law, in property rights, in the independence of monetary institutions. These are areas where China's authoritarian political system creates real doubts among potential reserve holders. The US government can sanction foreign entities in various ways, but it has not, at least not yet, seized foreign central bank holdings of US treasuries without cause. China's government has a track record of actions that make foreigners less confident their assets would always be secure. This is not to say that the yuan will never play a larger international role. China's economic weight is too large to be ignored, and the trajectory is toward greater yuan internationalization over time. But replacing the dollar as the primary global reserve currency would require China to make institutional changes, particularly regarding capital account liberalization and the independence of monetary institutions. That would involve real trade-offs with other policy objectives. And there's a network effect problem. The dollar is dominant partly because everyone uses it, which makes everyone want to use it, which reinforces its dominance. Breaking that equilibrium requires a very large coordinated shift that is very hard to engineer. Section 7. Weaponizing the dollar and the backlash it's creating. Here's a relatively recent development that deserves serious attention because it may ultimately do more to challenge dollar dominance than any deliberate attempt by China or anyone else to create an alternative. The United States has, increasingly over the past 2 decades, used the dollar's reserve currency status as a geopolitical weapon, because international financial transactions overwhelmingly run through dollar clearing systems, primarily through American banks and through the SWIFT messaging system. The U.S. has enormous leverage to cut countries and entities off from the global financial system simply by threatening to exclude them from dollar clearing. This is the mechanism of financial sanctions. When the U.S. imposed sanctions on Iran, it was able to largely cut Iran off from the global financial system because Iranian banks couldn't process dollar transactions without going through U.S. regulated institutions. The same applies to sanctions against Russia following the 2022 invasion of Ukraine, which included the unprecedented step of freezing approximately $300 billion of Russian central bank reserves held in Western financial institutions. The freezing of Russian reserves was a watershed moment. For the first time, a major economy's central bank reserves, money held in what was supposed to be the most secure, apolitical of assets, the reserve currencies of stable Western economies, were seized as a political act. The message this sent to other countries was not subtle. Your dollar reserves are not truly yours if the US government decides otherwise. China took note. Saudi Arabia took note. India took note. Every country that holds significant dollar reserves and has any reason to be concerned about its geopolitical relationship with the United States took note. The result has been a gradual, or still early, still modest, but real, diversification away from dollar reserves. Central banks have been buying gold at rates not seen in decades. Bilateral trade agreements are increasingly including provisions for settlement in local currencies. China has accelerated its yuan internationalization efforts. The BRICS nations, Brazil, Russia, India, China, South Africa, and recently expanded to include several others, have been discussing alternatives to the dollar-based system, though without yet agreeing on anything concrete. The irony is that America's willingness to weaponize the dollar's reserve currency status may be the greatest long-term threat to that status. The more visibly political the dollar becomes, the more it is seen as a tool of American foreign policy rather than a neutral international monetary infrastructure, the stronger the incentive for other countries to build alternatives. No country wants to be dependent on a system that can be turned against it at any time. This doesn't mean the dollar will be displaced anytime soon. The network effects are real, the alternatives are still severely underdeveloped, and the structural demand for dollars is still enormous. But the trajectory has shifted. The question of whether the dollar's reserve currency dominance is permanent, which seemed almost rhetorical 20 years ago, is now a genuine topic of serious analysis. Section 8. The dollar today, still king but watching its back. The dollar's position in 2024 is this: still unambiguously the world's dominant reserve currency and international medium of exchange, but facing a degree of strategic pressure and deliberate diversification that it hasn't faced in the Bretton Woods era. About 58 to 60% of global foreign exchange reserves are held in dollars, down from roughly 70% in the early 2000s. Oil is still predominantly priced in dollars, though a growing number of transactions, particularly between China and its trading partners, are occurring in yuan. Most international bond markets still function predominantly in dollars. The SWIFT system, though under challenge, still processes the vast majority of international financial messages. The dollar's day-to-day dominance in currency markets is staggering. The Bank for International Settlements Triennial Survey finds that the dollar is on one side of approximately 88% of all foreign exchange transactions globally, every single day. The euro, the second most traded currency, appears in roughly 31% of transactions. The numbers don't add to 100% because every transaction involves two currencies. What does this mean in practice? It means that when a Thai company wants to buy goods from a Brazilian supplier, they will almost certainly not exchange Thai baht directly for Brazilian reais. They will exchange baht for dollars and then dollars for reais. The dollar is the intermediary in most cross-currency transactions, even when America is not involved in the underlying trade at all. This is the vehicle currency function of the dollar, and it's one of the most concrete expressions of its dominance. The dollar's reserve currency status is ultimately a story about network effects, institutional trust, and historical momentum. America built the post-war monetary system. It happened to be the right country at the right time to do so, and the advantages of that position have been self-reinforcing ever since. The system benefits America, America benefits from the system, and the system is therefore maintained. Whether that self-reinforcing equilibrium can be disrupted by geopolitical shifts, by the weaponization of dollar sanctions, by China's patient long-game strategy, or by America's own fiscal mismanagement, is one of the most important and genuinely uncertain questions in international economics. But here's what we know. The dollar didn't become king by accident. It became king through a specific historical confluence of economic dominance, institutional design, geopolitical deal-making, and, crucially, the consistent maintenance of the institutional credibility that makes people trust it. The day those institutions cease to inspire confidence is the day the dollar's dominance becomes genuinely vulnerable. We've now established how the dollar got to the top. In our next chapter, we're going to explore the flip side of the reserve currency story, the world of currencies that have been deliberately pegged to the dollar, why countries make that choice, and what happens when those pegs catastrophically break. Currency pegs are, in many ways, the most dramatic and crisis-prone arrangement in international monetary economics. They can work brilliantly for years, sometimes decades, and then they can fail overnight in ways that are devastating for the countries involved and instructive for everyone watching. The Asian financial crisis of 1997, the Argentine convertibility collapse of 2001, the Swiss franc shock of 2015, the Egyptian pound crises, the Turkish lira debacles. Each of these is a story about a currency peg and what it costs when the peg breaks. Let's go there next. Conclusion. The price of trust. We've covered a remarkable amount of ground. Let's bring it home. We started with a simple question. Why aren't all currencies worth the same? And the answer we've discovered is both simple and endlessly complicated. Simple version, currencies are worth different amounts because the economies they represent are different in their productivity, their institutions, their monetary management, their geopolitical position, and the trust they've earned from the rest of the world. Complicated version, everything we've discussed in this video, the value of a currency is, at its core, a verdict. A constantly updated, collectively rendered verdict on the trustworthiness of an entire economic and political system. When you hold a currency, any currency, you are making a bet that the country behind it will continue to manage its affairs well enough that the currency will hold its value, remain accepted as payment, and continue to represent a claim on real goods and services. That bet is rational when the institutions are strong, the monetary policy is credible, and the economic fundamentals are sound. It becomes irrational when those conditions deteriorate. The history we've explored, from the gold standard to Bretton Woods to the Nixon shock, from Weimar hyperinflation to Zimbabwe to Venezuela, from the Asian financial crisis to Argentina's convertibility collapse to the Swiss franc shock, is a history of that verdict being rendered over and over again in ways that reward trust and punish its absence. Some of the lessons are obvious in retrospect, but apparently difficult to internalize in practice. Don't print money you don't need, build institutional frameworks that constrain monetary excess, be honest about the sustainability of exchange rate arrangements. Don't borrow in foreign currencies when your income is in local currency. These lessons have been available for 100 years, and yet they keep being forgotten, sometimes by countries that really should know better. Other lessons are subtler. The reserve currency system is not neutral. It confers enormous advantages on its holder and imposes real costs on others. Exchange rate stability can be a trap as well as a blessing. Deflation is as dangerous as inflation, just more slowly and quietly. The impossible trinity means that governments face genuine, unavoidable trade-offs and cannot have everything they want from their monetary arrangements. In market psychology, the collective beliefs and expectations of millions of traders and investors can create and destroy currency value in ways that are only loosely tethered to economic fundamentals, at least in the short run. What does all of this mean for you, as an individual navigating a world of multiple currencies with different values? A few practical takeaways. First, when you travel and exchange money, you are participating in a system shaped by centuries of monetary history, geopolitical arrangements, and institutional development. The exchange rate you get is not arbitrary. It reflects real differences between economies. Second, when you see a currency collapsing somewhere in the world, it is almost never simply a financial event. It is a political event, a verdict on institutions, governance, and the sustainability of economic arrangements. Third, diversification matters. Holding all your assets in a single currency, even a strong one, is a concentration risk. The most financially resilient individuals and institutions hold assets across multiple currencies and asset classes. And finally, the question of which currency is worth the most is ultimately less interesting than the question of what makes any currency worth something. The answer, trust, earned through consistent, credible, institutionally constrained behavior over time, is both deeply economic and deeply human. Money is, in the end, a story we all agree to tell together. The stories that hold up over time are the ones grounded in reality. The story of why not all currencies are worth the same is really the story of why not all institutions are equally trustworthy, why not all governments are equally disciplined, and why not all economies are equally productive. It's a story about human choices, human institutions, and the consequences for ordinary people of getting those things right or wrong, and that is a story that is still being written right now in the monetary policy decisions being made in Washington and Frankfurt and Beijing and Ankara and Buenos Aires and Harare. Every central bank meeting, every government budget, every geopolitical realignment is another paragraph in that story. The chapter titles change, the names change, but the underlying dynamics, trust, credibility, the relentless arithmetic of inflation and exchange rates remain constant. Pay attention to them. They matter more than most people realize. Thanks for watching. If your brain hurts slightly, that's normal and also means something went in. And if you now find yourself looking at exchange rate boards in airports with a new and vaguely unnerving awareness of everything they represent, well, you're welcome. And also, sorry.